Hey everyone! This week I'm going to focus on the employment market and the recently released jobs numbers. And I've got some good news and some bad news. I'll start with the bad news. Based on what we're seeing in the employment market, the Federal Reserve isn't facing a lot of pressure to reduce rates. If you watched Chairman Powell's appearance on 60 Minutes a little over a week ago, you may have picked up on his statement that we have a strong economy. Growth is going on at a solid pace. The labor market is strong, 3.7% unemployment, and inflation is coming down. With the economy strong like that, we feel like we can approach the question of when to begin reducing rates carefully. Powell went on to say the kinds of things that would make us want to move sooner would be if we saw weakness in the labor market or if we saw inflation really persuasively coming down. The kind of things that would make us want to move later would be if inflation were to be more persistent, for example. Personally, I take these statements to mean that the Fed feels good about where things are right now and they don't feel any urgency to make a rate cut. So that's the bad news. Basically, the economy and the employment market are actually doing really well. So the Fed feels less pressure to cut rates. But that's also the good news. The economy and the employment market are doing really well. If you look back at job creation since the beginning of 2021, there was a very clear trend, especially when you look at the trailing 3-month average job creation trend. The very smooth trend line shows steadily slowing job formation all the way through November 2023. Then in December, jobs bumped back up to 333,000 new positions, and that was followed by 353,000 new jobs in January. So we had this really nice trend of slowing but still positive job creation that suggested the Fed would cut rates soon. But now we have 2 months of accelerating job creation, and that's likely causing the Federal Reserve to hold off on their rate cuts for a bit. Now, I don't think the 2-month bump in job creation will spur inflation. In fact, the annualized pace of inflation over the last 6 months is actually below the Fed's 2% target. And if you just look at inflation over the last 3 months and annualize it, core PCE is just 1.5%, well below the Fed target. But like I said earlier, I don't think the Fed feels any real urgency to reduce rates. That's not to say the Fed won't reduce rates, but they may take their time and do it cautiously. Now, with regard to jobs, there are more people employed in the US today than ever before. About 5.4 million more jobs than the peak set before the pandemic. So basically, the employment market has been really strong. The subsector with the most net job gains is warehousing and storage, which now employs almost 35% more people than it did in 2019. That should tell you something about how industrial real estate has performed. Professional and business services, which historically supported office demand, is now 7.2% higher than it was before the pandemic. And in the fourth quarter of 2023, an additional 21 million square feet of office space was filled. That's the first quarter of positive office absorption since the second quarter of 2022. Construction employment is 6.9% above pre-pandemic levels, which makes sense as apartment completions are expected to reach a record 480,000 units in 2024. And industrial completions, which delivered a record 423 million square feet in 2023, is set to complete a still elevated 360 million square feet in 2024. But there are still employment subsectors that have fewer jobs today than they did before the pandemic, like clothing stores, where employment is down by 13.4%, and the accommodation subsector, which is basically hotel employment, which is down by 9.2%. But here's my point. The US employment market is very robust. And at the same time, inflation over the last 6 months has been below the Fed's target of 2%. As a result, looking at it from the Fed standpoint and considering the Fed's dual mandate to achieve maximum employment and keep prices stable, the economy is pretty much in the Goldilocks zone. So the Fed's decision to hold off on rate reductions honestly makes sense. But looking forward, the overnight rate is probably too restrictive, and the Fed knows that, which is why they're clearly signaling a rate cut this year. We don't know exactly when or by how much, but we do know what the trajectory will be. And that's why many commercial real estate investors are positioning to deploy more capital this year. We still face risks, and on that 60 Minutes interview, Chairman Powell enumerated the many risks that are still out there. But the overall outlook remains favorable. The big questions center on timing, which is why investors need to keep their eyes on the horizon.